Hello friends, today we are going to review the book One Up on Wall Street, a modern classic of stock investing and personal finance, written by the Wall Street legend Peter Lynch. From 1977, when he took over managing Fidelity's Magellan Fund, to 1990 when he retired. That fund grew from $18 million in assets to $14 billion. In those 13 years, a share of the Magellan Fund increased 900% in value, a 29.2% annual return, and outperformed the stock market by 13.4% annually. It is without much question the single greatest run of more than 10 years ever by a mutual fund manager. And it is the reason Lynch is an investing legend. One Up on Wall Street. This book focuses on the idea that observations in your day-to-day life can help you identify individual stocks that you could rely on. Great investors don't invest.
This is the first part, preparing to invest. Lynch said, investment in stock is an art, not a science. Do your own research and find a stock that you understand and believe in. Also, don't try to predict the economy. The economy is extremely complex. Don't get egotistical and believe that you know how it works. Just listen to what people say. Do your own investigating and follow up on what you find. Lynch offers 3 questions that need to be seriously answered before start investing in stock. First, do I own a house? If you don't, buy a house first. That does not mean fully owning a house, but just to be in one and have a stable non-adjustable mortgage. Second, do I need the money? Use extra money to invest. Money that won't devastate you with each loss. Only invest what you could afford to lose. Third, do I have the personal qualities it takes to succeed? Lynch lists patience, self-reliance, common sense, a tolerance for pain, open-mindedness, detachment, persistence, humility, flexibility, a willingness to do independent research, an equal willingness to admit mistakes, and the ability to ignore general panic. A high level of intelligence is not found in the list. You don't have to be a genius to succeed at investing. It is also important to be able to make decisions without complete information. Things are never clear in Wall Street. I am Juliana. Second part, picking winners, will be continued by Auntie.
Now we are going to talking about the picking winners. So the message of this entire portion of the book can sum up in 3 words. It's do your homework. Sure, you should seek out inspiration for the company to look into from your day-to-day life. The companies you observe doing good business and attracting strong positive word of mouth. But once you've identified the company, it's time to dig in and do the research. Lynch in this book divided the companies into 6 categories. They are slow growers, stalwarts, fast growers, cyclical, turnarounds, and asset plays. These 6 categories are according to the company pace of growth, whether it is fast or slow, its cycle of sales and profit, as well as its potential fatalities. What kind of research? Lynch literally goes on for 100 pages on the research one should do before the investor investing. Basically learn everything you can do about the company, what their balance sheet looks like, who their management team, how they compare to the similar company, and so on. Here are the 5 positive signs to look for. A low price to earnings ratio, especially as compared to the similar companies, a low percentage of institutional investor, insiders buyer the company stock, the company buying back its own stock, and the last one is a low debt to equity ratio, especially as compared to the similar companies. Even if you found a stock that looks really good according to the numbers, don't invest just because the numbers. Make sure you can describe why this business is a good company and why you are buying this stock. And the fact that the stock is going up is not a good reason.
Hello guys, so we're going to share you 5 tips of having a long-term view investment in stock. The first one is sell the stock when the reason that you have the stock is changed. For instance, if you think that a company runs by a very good management and because of those management you bought it, and then suddenly the management is being changed, then that is the time for you to sell the stocks. The second one, I think we need to buy the stock when everyone is selling, so we can take advantage from the very low price. And if you think it's a good company, then we should be buying it. The third tips, be patient. As long as the fundamental factors that you believe in those companies that you have invest is good, then we do not have to be panicked. Okay. The fourth tips, don't buy a company that you believe in just because of the stock is value. So don't only have a price as your only considerable. Okay. And the last tips is, if you can't convince yourself, when I'm down 20%, I'm a buyer and vanish forever. The fatal truth, when I'm down 25%, I'm a seller. Then you'll never make a decent profit in a stock. Okay? In other words, don't invest a company unless you have a compelling reason to invest it and believe in that reason. Those are 5 tips that we share to use, and good luck in picking your stock.
Welcome back, guys. One Up on Wall Street was written in 1989. So don't expect to find any great stock tips from the investment master himself in there. The former Fidelity fund manager does, however, provide the reader with an investment approach that can last a lifetime. Remember 3 points: do your research, understand the company, and think long term. Without a doubt, this is a must read for the rookie investor. His thesis is simple, logical, and easily replicated. Even if you don't agree with his philosophy, you should be able to draw some simple yet important lessons from his advice on buying stocks. If you are an advanced investor, savvy to the thrills and spills of the market, I still recommend this book. It might categorically change your investment strategy. Either way, the reader wins with this book. Investing in stocks is an art, not a science. Know what you own and know why you own it. So guys, keep investing, happy investing. Thank you.